Hello everybody, welcome to our class. Today's session consists of money and the economy. Let's get started with the fundamentals of the money supply. In today's session, we're going to talk about how money is perceived from the classical perspective and the monetarist perspective in the economy and the way it increases economic activity. The classical economist's traditional view of money is specifying that money supply or the amount of money supply in the economy directly affects the price level. And the price level can either increase or decrease depending on the direction of the money supply. The very basic, simple equation of exchange indicates that the money supply times the velocity of money, how quickly money travels through the economy, must be equivalent to the price level in the market times the level of output, or real GDP, which is in this case level as Q, in a simple economy. For short, money supply times velocity can be equivalent to the price level and the level of output in the market. Now, the classical perspective of money considers that both of them are directly, that money supply and the price level are directly related. Now, when we're looking at the velocity can change. Velocity is the average number of times that any dollar or any given money supply travels through the economy, or how many times is spent on buying goods and services in the market. And velocity can increase or decrease depending on the transactions occur, or can remain constant. The simple quantity theory of money specifies the velocity and real GDP, in this case, are considered to be constant, meaning that they are very stable and they remain constant, and predicts that changes in the money supply can lead to strictly proportional changes in the price level of goods and services. Meaning, if there's an increase in the money supply, it's going to directly increase the price level, assuming the velocity and real GDP are constant. This is a classical approach, and the classical economist, or the classical perspective of money, has basic assumptions. The first assumption indicates that changes in velocity are relatively small, if there are any. They're relatively small, and therefore velocity is constant over the short term. And the short run consists of short periods of time, 6 months, 9 months, or a year, or so on. And assumption number two is that real GDP, or in this case quantity, the level of output, is fixed also in the short term. It can change in the long run, but it's fixed in the short run. And therefore, anytime there's an increase in the money supply, it's going to affect primarily the price level rather than, in this case, the velocity or GDP, although those also can change. Now, when we're looking at the simple money equation and the classical perspective, the simple quantity theory of money has a direct effect on the aggregate demand for goods and on the aggregate supply of goods and services, which in this case is the ADAS framework. Now, an increase in the money supply will increase aggregate demand. When the money supply increases, it increases the amount of funds available in circulation, or in the financial system that consumers or individuals can use to engage in economic transactions, and therefore it increases aggregate demand through a systematic framework. The aggregate demand shifts to the right. If there's a decrease in the money supply, there's going to be a sequence of events that is going to lead to a decrease in aggregate demand and shift the aggregate demand curve to the left, or it decreases it. This change can be small, can be substantial, depending on how much the money supply actually changes. Now, if we look at model number one, which is model A, model B, and model C, we have different events taking place. The framework indicates here that price level in the vertical axis, real GDP on the horizontal axis. We have the yellow curve that indicates aggregate demand. Aggregate demand here, it's equivalent to consumption plus investment plus government spending and net exports. It's dependent on the money supply, which is labeled as M, money supply, and the velocity of money, how quickly money travels through the economy. And if you notice this bar, it has velocity V bar, is constant. So the velocity is constant, is not going to affect aggregate demand that much. We have the aggregate supply, which is on the green AS curve, the vertical curve. This is indicating that output is fixed and real GDP is represented by the aggregate supply curve AS upward sloping. Model C indicates that aggregate demand is going to be dependent on the money available, which is 800 billion, and the velocity of money, which is V2, velocity of 2. Money travels through the economy twice as much. If there's an increase in the money supply, as specified earlier, an increase in the money supply from 800 million to 820 million, or an increase in the money supply by 20 billion, is going to increase aggregate demand. And that increase in aggregate demand pushes it from point A to point B with a new equilibrium, directly influencing the price level as the simple quantity theory of money specifies, and the level of GDP remains the same in the short term, and the velocity remains the same, V2 to V2. The second option is that if the money supply declines from 800 billion to 780 billion, there's a decrease in the money supply, and the aggregate demand curve shifts down. It decreases to point C, the aggregate demand shifts down, and we have a new equilibrium at point C. And this is indicating that the price level is going to drop, is going to decrease, and the level of GDP stays the same. The only thing affected is the price level. The velocity is constant, if you notice, 2, 2, 2, but the main change is the money supply. Now, from what we have learned before, we know that prices are considered either to be flexible, inflexible, or constant or sticky, depending on the perspective that we're looking at. Here we're looking at the classical perspective of prices. Prices are adjusting in the direction of the money supply. Building further with the ADAS framework, if velocity is the one that changes, in this case, assuming it's not constant, if velocity increases, an increase in velocity, it will lead to also an increase in aggregate demand, and the aggregate demand curve will shift to the right. It will increase. And it will have the same effect as the increase in the money supply will increase aggregate demand. If there's a decrease in the velocity of money, if the velocity of money declines, how quickly it travels through the economy, if there's a decline in the velocity, then aggregate demand is going to decline. And that's going to shift the aggregate demand downward. What does that mean? It means that if the velocity of money in circulation declines, the number of transactions and consumption and expenditure decreases, and aggregate demand, which is the collective amount of demand for goods and services, also decreases. So that's what we're talking about here in terms of aggregate demand decreasing. Now, we're going to drop the assumption that velocity is constant and that GDP is constant, as you can tell from the previous statements. Because velocity can actually be different, and the level of GDP, the level of gross domestic product produced in the economy, can actually change. So that leads to a broader general theory of money and the factors that can cause different changes in the economy, including prices. In this case, we're going to look at the price level that depends on different factors and different variables. It's going to depend on the money supply, of course. It depends on the velocity of money, how quickly it travels through the economy. And it's also going to depend on the level of GDP, the gross domestic product, the real GDP, or essentially all of them are going to be affected and change. This is leaning more towards a different perspective of money and the economy, how money may function. And this is referred to as the monetarist view of the money supply and circulation in the economy and how it influences economic activity, which is a little bit different than the classicals. The monetarists are individuals that believe that the velocity is not constant. Velocity changes. And also believe that the level of output or gross domestic product does not change. It actually, the velocity of money, it's not constant. It changes. And the amount of gross domestic product also changes. It adjusts in the market. So the monetarists have four fundamental positions and beliefs. Velocity changes. It can change, and the velocity of money can be predicted. And also, the aggregate demand depends on the money supply and on velocity. Both of them can change, which is very similar to the classicals. And the short-run aggregate supply curve, SRAS, is also upward sloping rather than strictly vertical. It's upward sloping, and it's going to also allow for GDP to change. And the economy, fundamental point number 4, the economy is self-regulating, meaning that the economy is going to self-correct. The price level and the wages are flexible enough that they can adjust to changes in the market when we're looking at monetarist perspective on the view of money. Now, monetarism is a different approach to the aggregate demand, aggregate supply model, but it has the same fundamental principles. Here we have an increase in the money supply. If we have an increase in the money supply, it will increase aggregate demand, shifted to the right, and velocity is held constant, and the economy could be self-regulating, and it can go back to equilibrium. The first principle is very similar to the classical perspective. An increase in the money supply increases aggregate demand, and velocity is held constant. The main difference here is that the monetarists believe that the economy is self-regulating, and if GDP does in fact increase in the short term, in the long run, it's going to go back to natural levels. So let's look at the model. There's a lot of different things going on in this model. We have the price level on the vertical axis, the real GDP on the horizontal axis. We're going to start with the level of GDP, QN. This is the natural level of GDP. Aggregate supply, SR1. SRAS1, aggregate supply, short-run aggregate supply. Aggregate demand, AD1, at 800 billion, and velocity is 3. If there's an increase in the money supply, is going to lead to an increase in the aggregate demand. So money supply increases from 800 to 820 billion. Notice how the velocity is constant. Here, the level of GDP has increased slightly from the natural levels to a higher point in the short term. According to the monetarists, the economy is self-regulating. There's going to be flexibility of prices, and there's going to be an adjustment process. Since the economy is self-regulating, we're going to have the aggregate supply in the short run shift to the left, and we're going to have a new equilibrium point, which is going to be an equilibrium 3. Higher price, P3, and we go back to the natural levels of GDP. Here we have a fundamental principle. An increase in the money supply can increase aggregate demand and stimulate economic GDP in the short term, but in the long run, it increases the price level significantly more. Or if this continues, it can lead to potential inflation when the price level continues to rise, and the level of GDP remains unchanged in the long run. Now, what happens here if we have a decrease in the money supply? Well, what will happen if we do the opposite? A decrease in the money supply with the velocity held constant, focusing mainly on the money supply, it will shift the aggregate demand curve. It will shift the aggregate demand curve, and it will decrease it. It would lower it. Real GDP will decline significantly in the short term. The price level will decline, and with lower GDP, with less money supply, the unemployment level increases, and the economy may find itself in a short-term crisis. Let's look at the model. The long-run aggregate supply is the green vertical line. The short-run aggregate supply is SRAS1, and the aggregate demand is the yellow curve, AD. At equilibrium 1, price of 1, quantity in natural levels, QN. The level of money is 800 billion. Velocity is 3. If we follow the conditions, a decrease in the money supply decreases from 800 billion to 780 billion. It's going to lead to a decrease in aggregate demand. It declines the curve, it shifts it. That leads to equilibrium 2, temporarily a lower equilibrium. With an equilibrium of P2, we have a lower, with equilibrium 2, we have a lower price at P2, and the level of GDP has declined. If the level of GDP declines from Qn to Q1, closer to 0, we're looking to have low output, high unemployment, and an economy that may be facing a crisis. The monetarists believe that the economy is self-regulating, and in a significant time, or in the short time transition process from short to long run equilibrium, the economy goes back to equilibrium. Here at lower prices, we're going to have the self-regulating mechanism kick in, and the supply of goods increases due to the flexibility of prices and the flexibility of wages. The supply curve increases of goods, the supply of goods increases, pushing the economy back to equilibrium, equilibrium 3, with a lower price and a greater level of, back to normal levels of GDP, which is a little bit higher than when it declined. So GDP goes back to the natural state. Many the economists that are in the classical and the monetarist perspective sometimes find themselves somewhere in between in terms of the adjustment process. But for the most part, they are two different views of how this can work. The classicals have a different view of money. The monetarists have a slightly different view of money. Now let's take a look at velocity. What happens if velocity is the one that changes? Let's consider in the monetarist perspective. Recall that the classicals believed that velocity was constant. Here the monetarists assume the velocity does increase. The monetarists see that an increase in velocity can create an increase in the aggregate demand curve, and it will shift it to the right, and the level of GDP will also increase, and the unemployment will decline. So we have a similar model, but in this case, what's changing is the velocity of money. We have the level of GDP, QN, long run aggregate supply curve, the aggregate demand, AD1, the yellow curve, the aggregate supply, which is the SRAS1, yellow blue curve. The level of gross domestic product, QN, is a natural state. Notice how money is 800 billion, and if there's an increase in AD from AD1 to AD2, the money is still 800 billion. What's increasing this curve from AD1, from the yellow curve, to the red curve, AD2, is an increase in the velocity of money. The transactions of money, or how quickly money travels through the economy, it goes from 3 to 4. That increase in the velocity creates a new equilibrium, P2, price of 2, equilibrium 2, and with a higher GDP in the short term. This higher GDP can actually increase GDP for, like, for example, a year. 1 year, we can have higher levels of GDP, that's QN. But in the long run, after 2 or 3 years, it goes back to its normal levels, Q of N. So while we can experience high levels of GDP, Q1, with low unemployment, high output, in the long run, the adjustment process, the self-correcting process, is going to push the economy back to the natural level, Q of N, at the new equilibrium, equilibrium 3, with a higher price, and GDP goes back to its normal level with natural levels of unemployment. If velocity declines, a decrease in the velocity is going to lead to a decrease in aggregate demand, and the level of, if aggregate demand declines, real GDP declines, and the price level declines, and when there's less GDP, less output, less demand, unemployment increases, as indicated by the model here. Given a decline in velocity, the velocity here is the one that's going to be changed. Aggregate demand, AD1, declines to this yellow curve. It's going to decrease from equilibrium 1 at a price of 1, natural GDP Q of N. If there's a decrease in velocity, notice the velocity here declines from 3 to 2. The velocity declines. decreasing the aggregate demand from the yellow curve to the red curve. We have a new equilibrium of 2, price of 2, with lower GDP, with less GDP. Here, real GDP and the price level decline. This lower price and lower GDP closer to 0 indicate that the economy is underperforming and the level of GDP has declined, prices are declining, and the economy may find itself in a short-term crisis. As the economy naturally adjusts and self-corrects itself, the view of the monetarists, the aggregate supply curve increases to the right, which is this blue curve, and we reach a new equilibrium, equilibrium 3, with even lower prices, and the level of real GDP goes back to its natural stages. Money supply can increase or decrease, velocity can increase or decrease, and the models can follow both of them respectively in that case, when we're looking at changes in the money supply or changes in velocity. Now, monetarism is well embedded within the economy. It has significant effects. The monetarists believe that the economy is indeed self-regulating and that changes in velocity and the money supply can directly influence and affect aggregate demand, as we have seen in the previous models. The changes in velocity and the money supply will change the level of prices and the level of real GDP in the short run. In the short run, again, we have to analyze the short run in different time periods. Some people ask, what is the short run? Well, it can be 3 months, it could be 6 months, it could be a year, it could be 2 years. The long run, it consists of significantly a longer period of time, like 5 years or so or more. In the long run, GDP goes back to its natural levels of output, and what actually increases is the price level. Think about, for example, I often refer to as that 70s show. Prices were relatively low, right? Prices were low. The economy increases, economic activity increases, the money supply increases. What happens 30, 40, 50 years later is we have higher prices, the level of output has increased, it has moved to a new level of equilibrium, and the price level has increased faster. Things are more expensive over time. That's known to be inflation, when we have a positive increase in the price level over sustainable periods of time, or a % change in prices. The inflation can be stable, can be low, or can be significantly high. It says continue increasing the general price level of goods and services, or in the consumer price index. We can have what is called one-shot inflation, which is a one-time increase in the price level of goods and services, and it doesn't continue. It just increases once and it stays there. That's considered one-shot inflation. Aggregate demand increases, we reach a new equilibrium, a new price, and it stays there. We can have ongoing inflation that just continues to increase all the time. Inflation can be demand-side induced by the aggregate demand side, or it can be supply-side induced. The aggregate supply can also generate inflation, depending on which of this is affected. Let's take a look at the demand-side inflation, the supply-side inflation, and then the difference between those two. So in Model A, we have the demand inflation. Here we have aggregate supply in the long run, the short run aggregate supply, aggregate demand, the yellow curve. We start in equilibrium 1, price 1, quantity of output, Q1, the level of GDP, Qn. Okay, so the aggregate demand shifts to the right. There's an increase in velocity, an increase in money, and increases aggregate demand. As a result, the price level rises here from P1 to P2. We have a short-term increase in the price, short-term increase in the level of GDP, and the economy goes to 0.2 in the short term here, the short term. Panel B indicates with higher GDP. Panel B indicates that once the aggregate demand increases to P of 2 here, aggregate demand equilibrium 2 and price of 2, the level of GDP is going to increase, and it's going to be greater than the natural capabilities. And in the long run, we're going to have a wage adjustment process when it comes to the self-regulating economy, and the aggregate supply is going to decrease and shift to 0.3, and we reach an even higher equilibrium with a higher price level of price 3, and we go back to the same level of output. What we end up with in the long run is higher prices, an increase in aggregate demand due to higher money supply leads to higher prices or higher inflation, and with natural levels of GDPs that are the same with demand side inflation that was money supply induced. What about the supply side inflation? Well, on the supply side inflation, the supply curve is the one that's going to shift. Okay, the supply is the one that shifts. We have model 1, which is model A. In the short run, we have the short run aggregate supply curve, the light blue curve, the long run aggregate supply curve, green. And here we have a decrease. The short run aggregate supply curve is going to shift or is going to decrease. GDP declines less than the natural levels. The price level reaches a new equilibrium, 0.2, with a higher price, and the economy moves from 0.1 to 0.2. The economy is producing less GDP, higher prices in the short term. Now, what can be done? Typically, when the supply of goods declines, that's indicating that there's less availability of inputs, or something's happening in the production process that is cutting the supply and is pushing price levels up. So model number B is indicating that because real GDP, it's less, this Q2 is less than the natural levels, the unemployment is beginning to increase, and the prices are increasing significantly with low output, high unemployment, and higher prices. That's considered in economic terms stagflation. When the economy stagnates or doesn't grow, or there's low GDP and there's high prices and it doesn't increase in economic activity and high unemployment. Some economists argue that when this happens, if wages are flexible and the economy self-regulates, aggregate supply is going to adjust, go back to equilibrium. And then this is going to shift the curve to the right and push it back to its natural stages. In the long run, it goes back to point E. That's a very difficult thing to argue in favor, because wages are set, they are established. Wages rarely decline. If anything, most people would like to get a higher wage. So we may have an increase in aggregate supply, but eventually you may end up with a higher price in real economic terms. Now, regardless of what is induced, demand side inflation, supply side inflation, if it's not controlled by either the supply distribution of goods, the supply channels and distribution of goods, or by the self-correcting process, or the U.S. Central Bank, or the government in different ways through fiscal policy, we can have what is called continued inflation. And continued inflation is a consistent, ongoing increase in the price level. It just continues to rise. And the price level is measured by the Consumer Price Index, CPI, and it can increase from one year to the next, to the next, to the next, and so on. So here, Consumer Price Index increases from 100 to 110 to 120 to 130 to 140, indicating that the basket of goods and services is becoming more expensive as time goes on. Each year, goods and services become more expensive with continued ongoing inflation. The economic model of continued inflation continues to increase the price indefinitely, and it can go to erratic inflation if it's not controlled. So continued inflation here is as the increase in aggregate demand occurs, in one-shot inflation, if it doesn't stop at one point and continues to rise, then it continues and it becomes to be known as continuing inflation. This is considered erratic inflation or unstable inflation. And this is rarely possible, but it can happen. We have countries that have experienced significant inflation. Zimbabwe, Venezuela, ongoing countries with higher inflation rates, nominal rates of inflation that is quite significant. Today, both the CPI and the level of GDP are significantly much higher than they were in the 60s and 70s. We have more output, more goods and services, a lot more products, and the prices have increasing as well. And the price level has increased slightly. And we have had periods of high inflation years and also periods of stable inflation. Now, inflation has significant burdens. If continued increases in aggregate demand create continued inflation, what creates the ongoing increases in aggregate demand? Essentially, what creates an ongoing increase in aggregate demand, and the only factor that can continually bring continued increases in the aggregate demand, is the money supply. Too much money chasing too few goods and consumers demanding goods and services can indeed increase the aggregate demand for goods and services in the market and generate inflation through the money supply process, or significantly increases in the money supply when we're looking at economic activity. So it's important to maintain stable money supply factors in any economy to prevent ongoing inflation. Here we have the economic model of ongoing continued inflation, and it's not pretty. The model looks very complex. There's a lot of things going on. It looks very tedious. I myself find this model to be very tedious, but the main emphasis here is that the model is showing continued ongoing inflation. Model 1, it increases aggregate demand from AD1 to AD2, and then we go back to equilibrium and 3 through the supply side, to the supply curve, and from AD2 we increase aggregate demand to AD3. Aggregate demand continues to increase and continues to shift to aggregate demand 4, reaching a higher price level. Now, if it just stops at AD2 and that stays there, that's one-shot inflation. When we're looking at ongoing increases in aggregate demand through the economy, we're going to have ongoing inflation for a long period of time. It can also happen on the supply side. Model B indicates an economy that is experiencing ongoing inflation from the supply side of goods and services. If the supply of goods decreases, it shifts to 0.2. Then the self-correcting mechanism leads it to equilibrium 3. The supply curve shifts from S2 to S3. The correction mechanism shifts the curve to long-run equilibrium. And then the supply curve shifts again to S4, and it continues to go indefinitely. Now, in aggregate demand, as in the aggregate supply, this needs to be corrected. And ongoing increases in aggregate demand and ongoing increases in aggregate supply can both lead to continued erratic ongoing inflation, which is not good. It's not good for the economy, and it's not good for prices and consumers' consumption. Now, the supply of money can influence aggregate demand, can influence the level of GDP, can influence the price level. It also influences the interest rate. The interest rate in the loanable funds market is affected by the money supply. Here we have the loanable funds market, the level of interest rates in the vertical axis, the quantity of loanable funds available in the horizontal axis, the supply of loanable funds, and the demand for loanable funds. The supply of loanable funds is upward sloping. Higher interest rates lead to higher returns, so people are willing to supply more funds. And the demand for loanable funds is downward sloping because most consumers will like to demand funds at lower interest rates. Where both intersect, we have an equilibrium interest rate. That is the market interest rate in this particular case. As we move forward, with an increase in the money supply, what's going to happen is if there's an increase in the money supply or the supply of money, the supply of money is going to shift to the right. If there's an increase, it's going to shift to the right, and that's going to affect the level of interest rates. Here we have in model B and C. What creates this shift in the supply of loanable funds from SLF1 to SLF2, the supply of loanable funds 2? Well, there's two things. There's either more people saving their money in the bank so they can supply the funds for lending, or there can be more money supply in the market so the supply of loanable funds has increased. And when the supply of loanable fund increases, the supply curve here, it looks like it's going down, but it's not. It's going away from zero, so it's shifting, it's increasing, it's shifting to the right. The supply of loanable funds increase, putting a downward pressure on the interest rate. Interest rate declines. With lower interest rates, consumers are able to borrow more funds at a lower rate. Investors are willing to demand more funds at a lower rate, and an increased aggregate demand, and so on. This is considered a liquidity effect, which there's high liquidity in the market at a lower rate. Now, what about the demand curve shifting? If there's an increase in the demand for loanable funds, more investors demanding more funds, more consumers demanding more funds, the market in general demands more funds, the demand for funds can increase, and those demanding funds can create a new equilibrium at point 2 at a higher rate than before, even if the supply of loanable funds has increased to satisfy the funds available in the market at lower rates. But if consumers demand more money, then the interest rates rise and economic transactions increase, and the market continues to change. The supply of money affects the supply of loanable funds and the level of interest rates, along with aggregate demand, aggregate supply, and GDP and prices. This is the loanable funds market and the level of interest rates. We have several interest rates in the market, and one of them is the nominal interest rates. And the nominal interest rate is the interest rates that is actually charged to consumers or to individuals in the actual market. The nominal interest rate, consider your credit card rate, for example. The credit card interest rate that you have to use as a consumer, it's your nominal interest rate that you pay back to the bank in order to use those funds. And the nominal interest rate is equal to the real interest rate in the market plus any expected inflation that they are accounting for, and they charge that on to the consumer or to whoever's using those funds. So if the bank is going to charge 10% for lending you the funds, they're going to add an additional 4% if they expect inflation at 4%. So the nominal rate is going to be a total of 14% or more. And you'll be surprised. In the US, inflation is stable around 2 to 3%. So the nominal rate that banks really make is quite significantly a lot, especially when they charge 21% interest rate on credit cards. That's when I'm referring to the real interest rate. What are they really charging? The real interest rate is the nominal interest rate minus the expected inflation. So if the bank is charging you 10% if the bank is charging you 21% nominal rate and the inflation rate is 1%, then in real terms they're taking 20%. When the expected inflation rate is 0, then they take everything. The real interest rate is equivalent to the nominal rate. If there's no inflation and they are charging you 21%, and inflation is 0, and inflation has been 0, some cases have been negative, then they're charging you the full interest rate in real terms as net return in the market. So thank you everybody for joining the session. Let's continue next time. Have a good afternoon. Enjoy the rest of the day.